This makes sense if we use two different stories, one from someone very famous and one from someone you've probably never heard of. I think this is probably one of the most important keys to being a successful investor, and it's not just in my opinion. Let's start with this one, who's a lot less popular. Back in 2014, the US news media started running a story about a mysterious donation of over $1 million donated to a local library and nearly $5 million donated to a hospital. The story takes place in rural America in a town called Brattleboro, which is in Vermont. They'd never seen anything quite like this before, but the extraordinary thing wasn't just the amount of the donations, it was who the donations were from. You see, all of this wealth wasn't donated from some billionaire business person or some huge global corporation. It came from an unassuming man who'd worked his whole life in the army, at a gas station, and even as a janitor. The money didn't even come from any inheritance or any lottery win or anything that exciting. It was all from money that he'd earned doing relatively low-paying jobs. The problem is, even after working for 40 years, saving all of that money away, you'd still never be able to get that kind of amount of money. So how did this guy do it? This right here is Ronald Read. There's not many photos of him around, unfortunately, but this was his signature shirt, and apparently he definitely wasn't a flashy person. His secret in getting all of this money though, all comes through the power of investing. So every time he got paid, whether that was from the army paycheck or the gas station, he'd buy stocks. This guy was smart. He invested money as often as he could and made sure that he kept really frugal as well, not blowing all his money on expensive clothes or cars or anything else. Read would buy companies that he knew and understood, big blue chip names, most of which would pay really nice dividends. Those were companies like Johnson & Johnson, General Electric and Procter & Gamble, all names that are very much still around today. With those dividends, he'd take that money and guess what? He'd go ahead and just keep buying more stock. He was well diversified too, and by the time everything was added up, he had shares in 95 different stocks. And most of these were all recorded on those old share certificates too, which stacked 5 inches high in some safety deposit box. In total, after he passed away, it was revealed that he'd amassed a fortune of over $8 million in total. His wealth had all been kept quiet from everyone he knew, and there was even a time when someone paid for his food once because they thought he was homeless. I might actually have to give that a try next time I'm in Nando's. Anyway, here's the lesson, and here's the single most valuable tool that us investors have working for us. Compound interest. This was described by Albert Einstein as being the 8th wonder of the world because of how amazing it is. He said that those who understood it would earn it, and those who didn't would pay for it. The idea is simple, and it also ties into the second story as well from a much more famous face. But quickly, let's just break down how this works because there's many people out there who still don't get it. Compound interest is the idea that over time, when an investment gains interest, it ends up snowballing into something much, much larger than its original size because the returns, the actual value you get back, compounds, meaning that you gain money from the gains. Here's a great example. If we say we have $100 or £100, the currency is completely irrelevant, and then from that money, we're going to get an interest rate of 10% per year. Let's say the bank is being really kind. I know it's not very realistic at the moment. After the end of the first year, we'd have $110 or £110. A really simple calculation. 10% of $100 is $10. So now we just add the two together and we've got $110. Now, here is where the fun part begins. In year 2, instead of just getting another $10, we actually make a little bit more because we're now getting 10% interest on $110, not just $100. This means that by year 2, we'd have $121. 10% of 110 is of course $11. Each year gets better and better, and if we still get the rate of 10% and leave all of our money in there, if we skip forward say a few years to 7 years, we'd have double our money. And after 20 years, we'd have $732.81, which is an increase of over 600% from our initial deposit of just $100. That's the magic of compound interest, and if you want to have a little bit more fun, here's how long it would take to have $1 million from just $100 deposit. If you still get 10% per year after 93 years, you end up with this. $1,052,452. Now sure, it won't be quite worth the same as $1 million is worth today, but you still get the point. Compound interest truly is the 8th wonder of the world, but here's the big catch. Just before we speak about the big catch, if you are enjoying the video, please do me a huge favor and hit the like button. It really does help push the stock market higher and increase your average returns. Okay, maybe not quite that, but you do get the message. Anyway, now that that's done, back to the video. It's all about time. Sure, it does matter how much you put in, it's probably the second most important factor, but really the most important thing is doing it consistently over such a long period of time that you really get to enjoy those compounding returns. Here's where our second story comes in, but this time we're talking about everyone's favourite investor, Warren Buffett. Now, this isn't a man who'd get his breakfast bought for him. He'd much prefer to pull up to the McDonald's drive-thru every day and get the same order. I seriously worry about this man's diet, but to be fair, he's made it this far, so I'll leave him to it.
I'll have a sausage McMuffin with egg and cheese.
If you didn't already know this, Warren Buffett's wealth has enjoyed a spectacular rise, and other than picking some great stocks alongside Charlie Munger, he's completely taken advantage of compound interest to get there, reinvesting dividends from companies like Coca-Cola and Apple more recently along the way, and because he's been investing for such a long time, those investments keep snowballing and rising in value. And here's the most interesting thing worth noting that hopefully will inspire you a bit along your own journey. Warren Buffett actually accumulated most of his wealth after his 65th birthday, 95% of it in fact. Now, this doesn't mean that he was poor by anyone's standards. He was wealthy very early on in life, but after investing for so long, he made compound interest work in overdrive mode, turning his millions into tens of billions to where it is today. Funny to think that if he just retired in his 50s or 60s, most of us may have never heard of the man, unless we bumped into him at McDonald's.
Hi, how are you?
But here's the catch though, and the bit that stops most people getting there, and I think it's a couple of things. Firstly, the world doesn't go so smoothly like this. Getting 10% interest every year guaranteed would be virtually impossible and almost certainly too good to be true. You'd snap someone's hand off if they could give it to you like that. Once you get some money to invest together in the first place, I think the hardest thing is actually being able to stomach the real world volatility. As we know, the stock market can be a wild ride. Even if we invest into index funds, we're still going to have crashes and corrections just like the one we're going through now. If you just started last year and you've been averaging into the market each month, you're probably about the same place as where you started. So you're probably thinking at the moment, is all of this even worth it? The only thing keeping you going has to be the long-term view. The S&P 500, if we use that as our benchmark for the stock market, has delivered on average 10% per year over the past century. And as I've stressed before in previous videos, the key word here is really average. There's been many years where the market has rallied 20%, but there's also been plenty of times when the market has crashed or entered into some kind of recession. In order to take advantage of the great years, you've also got to live through some of the bad years too. If I ever need to be reminded of the past, here's two things I look to for help. First up is this chart which shows us the returns of the S&P 500 over the years. You'll see that the swings can be pretty vicious, but focus on two key things here. Firstly, there's more years when the market goes up than it goes down, which is always a good thing. And secondly, the average figure of 10% per year almost never happens because it's just an average. So if you do start investing today, next week or next month, go into it expecting it to be like this and you'll sleep a lot more soundly at night. The second chart I like to look at is much longer term one of the S&P 500 from about 1950 or wherever you can go back to. And this is done on a log scale. All this means is it's much easier to visualize than in linear form where the graphs look just a bit stupid. There's two things to take from this graph, and then it's the long-term trend of the stock market is up as we improve our economy, companies make more profit and GDP increases throughout the year. And that the actual prices of the stock market are always varying around that trend line, sometimes going too high and sometimes falling pretty cheap. All of this short-term noise, crashes and corrections are all just part of the investing game because remember, we're only human, we're all driven by emotions and we're all trying to play different games. One thing to remember is that we've got no idea at any point where we might be, and the cycle isn't something that can be predicted, but knowing that is the way things work is massively helpful if you're on the edge of quitting right now and selling everything. The bottom line is that nothing beats dollar cost averaging over a really long amount of time, and that compound interest works best when you give it the maximum amount of time to work out. Starting 5 or 10 years earlier on your investing journey can make a huge difference. But one thing I'll always say, it's never too late. You just might have some less choices and have to be prepared for more risks because nobody wants to try and plan retirement or start to take money out of their investment when the market is crashing. That's probably one of the worst things you can do. As an incentive, before we head to the end of the video, here's two situations for you, again using our trusty compound interest calculator. One example is when we start investing when we're 30 and one is starting when we're 40. We both put in £200 a month and we stop at age 65. So the 30-year-old has 35 years of investing and the 40-year-old has 25 years. We'll say that we get 8% a year to be fair, and now let's have a look at those numbers. Our 30-year-old has a fortune of £458,776.50, which is a really nice sized pot, and our 40-year-old has £190,205. It's less than half unfortunately, but it's still a good sized amount of cash. However, it's not over yet. If you can afford to, by adding a little bit more money per month, you can still beat that lucky 30-year-old, but you would need to add in £500 a month instead of £200 a month. And you'd end up pipping him to the post with 475k. Time really makes so much difference with investing. Don't leave it too late and do this for as long as you can. I'll be with you along the way, sharing all of my experiences, because at the end of the day, we're all in the same boat. And if you do want to see any of my personal investments, I did just release my latest Hargreaves Lansdowne portfolio video. Be sure to check that one out after this one. And don't forget, I've got them all saved in a nice playlist for you on my channel, and the link is in the description for you as well. So you can have a nice, good nosy around. Anyway, thank you so much for watching to the end. Drop me a like on the way out, subscribe for many more, and as always, happy investing.